Hi, welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
So it's February right now, and so we're in the thick of tax season.
Yep.
And I'm sure maybe some of you, I know I've had a lot of clients, they're getting all those documents in and they're getting those 1099-Rs, and some of them actually took early distributions from old IRAs, even from their 401ks, old 401ks, and they always tell me that they took enough money out for the tax. They had them to cover the tax. And not a lot of people realize when they take those distributions, sometimes wherever the money is, they only will take 10% just to account for the 10% tax, or your penalty, I should say. Some might not even take any tax, but usually the majority of the time, they don't account for the full tax situation. So the tax bracket that you're in, and then as well as the penalty. And so we found a great article in the Wall Street Journal covering these early withdrawals from retirement accounts. And the article just highlights some ways to help avoid maybe paying that penalty if the distribution is for a certain thing. So we're going to dive into this article and just kind of highlight a couple key points from that.
And before we do, if you are going to take an early withdrawal, always reach out to your tax advisor to get their 2 cents before you make it a distribution, because sometimes, like Jay was saying, the taxes aren't accounted for at the time. So make sure you double check on that.
Okay, so like we said, it's tax time. And a couple weeks ago in the Wall Street Journal, Laura Saunders had wrote an article on the personal finance side, just talking about some of these penalties that people are being assessed and just kind of ways to get around it. And they've highlighted a few real life examples too, which is kind of neat. Kind of just to start out though, with any type of early withdrawal distribution, and what that means is taking monies out of any type of retirement account pre-59 and a half, you're going to be paying income taxes on that because that's all money that has been shielded from taxes. You get a tax deduction for putting money in there. But on top of that, you're going to be assessed an early withdrawal penalty. So the federal, it's 10%. That's just 10% of the gross distribution. And then depending on what state you live in, that there could be a separate penalty.
And just wanted to add to that, that's 10% in a state penalty on top of what you're already going to be taxed on that gross distribution. So that's in addition. And that's, I think, where a lot of people get kind of messed up. They say, well, I withdrew early and they already took out the taxes. But like you had mentioned earlier, a lot of times they only take care of the penalty, or they don't really know your full tax situation. So if you have $100,000 of income and then you took out money early out of a retirement account, you have ordinary income on that gross distribution and now a penalty. And I think a lot of people miss that. The tax ends up being a lot more than people realize.
Correct. Yeah, especially if you're in your working years and you have, let's just say dual wages if it's a married couple. That actually could bump you up a tax bracket depending on how big the distribution.
Yeah.
Anyway, so yeah, we have these penalties that are assessed. Now, she starts off this article with a pretty interesting example. So they say a single 30-year-old with a top tax bracket of 22% needs $25,000 to pay for career expanding higher education. If she can take those funds from a Roth IRA, and we'll go a little bit deeper in that, but if it's from Roth IRA contributions, then she would not owe anything in taxes or even in penalties to begin with. But if she takes them just from a traditional 401k or even just a traditional IRA, she could owe about $8,000 in tax as well as in that penalty. And then she makes a note here, if you take a loan from the 401k, that's a different matter. So remember, a loan, real quick, when you're taking monies from yourself with your 401k, you're paying yourself back plus interest. So it's not really deemed as a distribution.
Right.
But anyway, so thought that's just an interesting thing, because just a little bit of help with tax planning could help you save, in this case, $8,000, and that's not even accounting for California or whatever state you're in.
Well, and a lot of people use these accounts as kind of these buckets of money that they don't really pay all that much attention to until they have a need. Like in this case, $25,000 to have some higher education expenses, and they see that account and they say, well, I have money over here. Why don't I just take that money out and pay for it? And depending on what type of account and how you go about it, there may be tax and penalties that you incur. And like Jay said, just doing some tax planning and maybe strategically taking it from somewhere more beneficial, you can help avoid some of those penalties at least.
So when you're taking monies out of any type of qualified plan, there are certain ways or exceptions to help avoid the early withdrawal penalty. So, in this example, they mentioned taking money out for higher education. That is actually not with all plans, but that's actually one of the ways you can avoid paying that 10% penalty if it's used for schooling purposes.
And that's from an IRA?
That's from a qualified plan, which would be an IRA, SEP IRA. In this case, 401k. Excuse me. Money's coming from a 401k. There also are certain exceptions, but in this case, college or higher education expenses don't qualify for that. There's actually a pretty big list of what qualifies. Another common one is people hear that, well, if I take money out of my retirement plan, I can take up to $10,000, and if it's for a first-time home purchase, then I don't have to. Sometimes they say I don't have to pay any tax.
Right.
Yeah. Well,
the IRS is not that generous.
No, it's not. Now, if it's from a qualified plan, so that would be IRAs, SEP IRAs, Roth IRAs, and so forth, then yes, you could shield up to $10,000 from the penalty. You're still going to pay taxes on that. If it's from a 401k, that's a completely different story. And in fact, here's another example. So this is from 2001. Excuse me. Just highlight it here. So it says Keith Lamar Jones, a professor of accounting at the University of Kansas, learned this specific scenario the hard way. In 2001, he withdrew about $30,000 from an inactive 401k to help pay for a PhD and a first home. He paid tax on the withdrawal, but not the 10% penalty usually owed by those under 59.5, because he thought there were exceptions for both higher education expenses and first-time home buyers. And then it kind of goes on here. The Internal Revenue Service noticed, and it assessed a penalty of about $3,000 because the exceptions he counted on apply only to withdrawals from IRAs and not 401ks.
Yeah, you really got to understand what account you're taking it out of. Mm-hmm. Like in this scenario, he maybe could have taken, it from a different account and not his 401k and avoided that $3,000 penalty, which is pretty steep when you're, trying to get higher education and buy a house. Nobody wants to be forking out $3,000 for nothing.
No, exactly.
So what are some ways that we can avoid the penalties if we have, say we have all these different accounts? What are some of those ways that we can avoid it?
Yeah, so we mentioned this earlier in one of the examples that the article had highlighted. But with Roth accounts, if you've had that account open for at least 5 years, you're allowed to withdraw essentially up to what you've contributed over the course of its account opening, mm-hmm. and not pay any taxes on it. It's just a return of contribution, so to say.
Right. So
if you've had an account open for 10 years and you've contributed, let's just say $30,000, and let's say it's worth $60,000 just with market growth, you can withdraw up to $30,000 tax-free because that's just a return of contribution. And the 1099 is going to show that. You'll actually have to know too just what the exact amount of contributions you've made, because sometimes the brokerage or the wherever the funds are, they won't know that. But you'll know on the return, this is just a return of contribution, and you don't have to pay any taxes on that. Now, if you withdrew the whole amount, you only pay taxes on the gain, so to say.
And that's very specific to a Roth account. An IRA is not that way, because if you think about it, a Roth account, the money that you're putting into it, you're not receiving a tax deduction. You're putting money in, post-tax, and it's growing tax-free, unlike an IRA. So, there's a big distinguish there with a Roth per se.
Yeah. Another way too, this is kind of going back into the penalty-free exceptions. We've got a list here from the IRS's website, and you can see it's pretty extensive. And it breaks up, okay, what's considered a qualified or 401k, what's IRA, SEP, or simple, and it has the code determining it. But basically, we'll kind of just go over a couple. So let's say that the owner of the account died, and it either goes to the spouse or to whoever the beneficiaries are. If the beneficiary is pre-59 and a half, they can withdraw funds from that and not have to pay any penalty. They're still going to pay taxes, but there's no penalty assessed just because it was, they inherited that account. Another one here, so education, you can see no for 401k plans and yes for IRA, simple IRA, and so forth. So that's a huge one too.
Home buyer.
The first-time home buyer, so again, that's up to $10,000. No for 401k plans and yes for IRA plans. Here's an interesting one. So if you itemize and let's say that you had a bad year with medical expenses and you needed money just to help cover that, whatever amount is over the 7.5% of your adjusted gross income, then that amount that's over is you don't have to pay a penalty on that. So I'll kind of break it in simple numbers. Let's say your income's $100,000, 7.5% of that's $7,500. So in order to have a medical deduction, you would have to have over $7,500 in medical expenses, and whatever is over that is the deduction. So let's say you had $8,000 of medical expenses. So you get a $500 deduction. On top of that, let's say you withdrew $1,000 just to kind of help cover those medical expenses. You can avoid paying the penalty on up to $500, and then you do have to pay the penalty on the rest, but at least I can kind of help alleviate some of the hardship. But you can see there's quite a bit. Here's a big one too. So if you're wanting to roll your accounts over, to another plan or to an IRA, let's just say, in most cases you just do that trustee to trustee, where you don't touch the money yourself. It just goes from Plan A to Plan B, or 401k to IRA. Well, in some cases, some people might just withdraw the whole amount, and they have a check, and then they go and just deposit it themselves into the IRA, let's just say. Well, there's certain requirements with that, so you have to do that within 60 days of when you've received the money. Otherwise, then the whole distribution is going to be deemed as taxable. So you just need to make sure you plan accordingly for that. And on top of that, you can only do that once a year with rollovers like that. You can roll over old accounts to new accounts multiple times if it's trustee to trustee, but if it's in a scenario like this, where you're actually receiving the money and then you're depositing it yourself into the new account, you can only do that once a year. So just something to think about. But going back to the article, so like we mentioned, there's a couple differences between IRAs and 401ks with the penalty amounts that you can avoid. Let's see here.
There was one that's kind of interesting up here. Let's see. The penalty-free withdrawals from 401k and similar plans. So I thought this is kind of a little bit of a lesser known, exemption. So the 10% penalty doesn't apply to several types of early withdrawals from 401ks. In particular, workers who retire in the year they turn 55 or later and make withdrawals before age 59 and a half owe tax, but not penalty. That's kind of a odd exception. You don't run into that a whole lot, but that's something to be aware of as well, only regarding your 401k. Yeah,
and that's generally with public safety employees. So I think anyone in law enforcement is a good example, and they usually don't have 401ks. They usually have 457s.
Right.
And firefighters is another one too, but that's one we've kind of seen from time to time.
So I think one of the big ones too is this last one here that the article highlights. It's this 72T rule, and I think we've talked very briefly about it in other videos, but we didn't really go in depth. And it's kind of a complicated rule, but essentially there is a section 72T of the IRS code where they do allow you to waive the 10% penalty when you're taking out from an IRA or 401k, when you take equal payments for at least 5 years. And that's probably, you know, as deep as we want to get into it, because you have to structure the withdrawals in a certain fashion because it depends on how many different accounts you have and all sorts of things. But, you know, that is another one to realize, you know, if you are maybe retiring before age 59 and a half and you need to bridge that gap, you know, and you need to take money out of retirement accounts like an IRA before 59 and a half, there, you can use the 72T rule and structure it accordingly to at least avoid the penalty. And that can be to your benefit.
And then just one quick addendum, kind of going back to the top when we first started. I had noted that when we went through the one example with higher education, where this single 30-year-old took $25,000, went through the Roth or the 401k. I had noted that if in this case, if it was from an IRA, traditional IRA or even Roth IRA, I had said that's a qualified plan. That's not. You just have to excuse me on that. So a qualified plan is 401k monies, 457, 403b. So that's considered a qualified plan, and that's where you have the fewest amount of exceptions for penalties. Other accounts like traditional IRAs, it had SARSEPs, that was another one, but other accounts that aren't considered qualified, and that would be more self-managed, that's where you have much more leeway on what penalties they have. But we definitely recommend checking out the IRS's website just to see that full list of penalty exceptions and see, if you ever need money for any certain situation, that might be an option.
Yeah, I just think it's important if you're going to take out money before 59 and a half, you really need to seek out, like a CFP or an enrolled agent or a CPA, someone who, is more aware of all these different exceptions, because they're pretty lengthy and it really depends on your scenario. So we definitely, would advise that. But
so as you can see, there's quite an extensive list of just what's allowed for avoiding the early withdrawal penalties.
Lots of rules to know.
Yeah, and it has to be from certain accounts and whatnot. We do want to just really stress taking monies from qualified retirement accounts or just IRAs in general. This should be more of a last resort thing. Because you got to remember, these monies are earmarked for retirement. It's earmarked for a specific purpose. And unless it's just a last resort, you need it for a certain thing, it should not be touched at all costs until retirement. Yeah, you want that money to stay in the plan to continue to compound and continue to grow for that need down the road. Right.
But obviously things do come up, so we understand that. But if you do need to make a withdrawal like that, we definitely advise to seek out a CFP or an enrolled agent like Jay, your CPA, somebody that really knows, the ins and outs of these exceptions. So definitely advise that. But we hope you found this video helpful. If you do like it, please like and subscribe, and we look forward to seeing you in the next video. Take care.